Hello, everyone, and welcome back to the Clean Techies podcast, where we interview climate tech founders and VCs to discuss all things building and investing to solve the biggest challenge of our generation, climate change. Today, we have a pretty wandering episode with Alex Mitchell, the founder of Full Turn Capital. And in this conversation, we start out talking about different business models in the climate tech space. We then talked about Moats, which is actually a new topic we haven't brought up before. Another segment that felt very valuable was the section on debt financing types. He offered different ways to fund your project instead of just raising VC money. And then we talked about deal flow as an investor and how to navigate bandwagoning. I thought that was actually a pretty fun conversation as well. And then to wrap up the conversation, we talk about the value of incubators, which is something I'm pretty interested about, so I thought that was quite fun to talk about. But without any further delay, enjoy the episode. All right, man. Welcome to the podcast. How are you doing today?
I'm good. How are you?
I can't complain. I might have complained before the show, but we'll leave that for our offline conversation, man. How's things in sunny California?
We're just about to hit Memorial Day weekend. I have family visiting, so things are good. Things are great.
I can imagine in LA, you obviously have terrible traffic all the time, right? But on Memorial Day weekend, it's probably particularly bad as everybody's leaving to go to the mountains or somewhere in California.
Or heading to the beach, etc. Yes, but that's maybe one of the benefits of choosing to be a car-free Angelino, is you can avoid some of that traffic.
Yeah, that'd be interesting. Maybe we'll talk about that today. I would like to see a future where more cities in the US have good transit or public transit or other
Yeah.
ways to get around. Who knows? It doesn't have to be public transit. But yeah, let's get started. So tell us a little bit about yourself, kind of give us a background and what you're doing today.
Yeah. Well, look, again, thank you so much for having me. I come at clean tech from a real deep interest in transportation, um, a lot of young adolescent boys. I had a real interest in the automotive industry, but maybe more from like an industry perspective and not just cars are cool. So, like when I was a teenager, I took my savings of money from like lawn mowing and babysitting and put that in stock in a car company called Chrysler and started writing the CEO letters about, how he could do business better.
That's
And
awesome,
that,
actually.
yeah,
That's actually really cool.
and it was interesting. I mean, the stock appreciated a lot during high school, so that helped me afford college, but also actually led to my college internship at a car company at Chrysler, because they remembered me from when I was 13 and wanted to stay in touch. So that was sort of, like transportation has been a lifelong passion of mine. I grew up in Wisconsin. Back in the day, there used to be a manufacturing industry that touched automotive in Wisconsin, a lot less today. But that was just a part of my sort of formative years, that interest in automotive. And then my interest in climate came a little bit later. I was in my early 30s working at Toyota, and the Prius was a relatively new car at that time, to second generation, and it started me down a journey of really thinking and understanding why the Prius was on the market and what that represented. And up until that point, I'd really thought about all the positive benefits of transportation, right? Moving people and goods around the world is what creates access to education, access to jobs, access to healthcare. But when I started peeling back the onion on, okay, like why is the Prius important? It led me down a lot of research on really understanding some of the negative impacts of transportation, particularly from a greenhouse gas perspective. So I did a lot of research and said, gosh, I think if that's what climate scientists are telling us, and I believe in data, I really want to make sure that I'm focused on making sure that the transportation sector can decarbonize as quickly as possible. So that's what I've been doing the last 15 years. I worked at an EV startup in what we now call CleanTech 1.0. I worked for the World Economic Forum doing pre-competitive research in sustainable mobility. Worked for what was then called Peugeot, now Stellantis, on a lot of electrification strategy. And then more recently, over the last 5 years, I have been investing in startups. And that includes about 5 years at Los Angeles CleanTech Incubator, where I'm currently a senior advisor, but was in a day-to-day management role. Probably a lot of the audience knows LACI, a nonprofit clean tech incubator that focuses on zero emissions mobility, clean energy, and circular economy. and oversaw our startup facing work, the recruitment programs, as well as the investments we made. And now my day job is serving as a senior advisor to LACI while I invest full time in decarbonization of transportation via a firm called Full Turn Capital. So that's my story.
Hey there. Quick break to remind any founders or VCs listening, if you are looking for deal flow, seeking to raise funding, looking for partners to help service your needs, or perhaps you're looking for corporate investment partners, feel free to reach out to us through our Slack channel, which can be found in the description. Because we meet a lot of people in this space, we set aside time each week to make introductions to the various people that we encounter. This is something we do free of charge in order to help these incredible companies solving climate change to scale. Looking forward to hearing from you in the Slack channel. I love it, man. I didn't realize you were from Wisconsin too. I didn't mention that, but I'm also from Wisconsin originally.
Oh,
There's
wow.
there's not
Okay.
many people from Wisconsin, you know. There's fewer people in this whole state than there is in, like New York City, for example.
I can
So it's
believe
kind of
it.
interesting. But okay, this is awesome. So I'm really curious about one thing in particular, which is how did you go from what you were doing with like group of PSA and during Planet, and then going into a kind of an advisory role or an investing role with LACI? Could you talk a little bit more
Yeah,
about that and your role there?
sure. So Lacey's, now almost 11 years old. One of the very first clean tech incubators in the nation, and certainly known as one of the best globally, really at that intersection of helping early stage founders figure out how to scale and grow their businesses. So I held a couple of different leadership positions at LACI, but really the last one was everything founder facing for LACI. So the startups we recruited into our portfolio, then the programs we have, our core incubation program at LACI is a 2-year program that kicks off with, for 3.5 months of curriculum, et cetera. And then the other thing I was overseeing was our investments. So LACI has a venture capital fund as well as a debt fund. And so making sure we were supporting the right startups at the right time with the right instrument, whether that was venture capital dollars or debt. Um, yeah,
Interesting. Okay, very cool. So I guess one thing I'd be keen to understand right now is could you tell us more about your investment thesis? Like what specifically do you focus on and why that? I mean, there's a lot of different ways to look at climate and investing, so I'm kind of curious to get your take on that.
sure. And I'll separate my role as a senior advisor from LACI from what I personally invest in. And so what I'm really personally investing in is really the red thread of what I've been doing the last 15 years or so of my career, which is taking a look at, pre-seed and seed stage business models across mobility. And mobility for me is, surface transport. So cars, three-wheelers, two-wheelers, trains, buses, trucks, but also aviation and maritime. So boats, ships, and planes. And really all the businesses there that are at that pre-seed and seed stage where we say, hey, there's really a strong amount of financial potential of this business. But as this business scales, really also understanding what's the greenhouse gas impact of that business and how can that take us on a trajectory that's much more Paris aligned. So really looking at all the businesses where I say, hey, there's really strong growth, but there's also a really strong and quantifiable greenhouse gas impact by adopting this technology or this business model. So that's sort of what I look for. I mean, that's sort of what's the, sort of the focus. Obviously, when I look at a particular deal, there's a lot more than that, including founder tenacity and grit, product market fit, and a lot about the sort of capital stack, given that clean tech can be sometimes more capital intensive than, say, doing dog walking as a service or, a software app. But really fundamentally, it's about those pre-seed and seed stage businesses where you say, look, there's huge growth potential here for the business, but also potential really meaningful climate impacts in this business.
I think it's kind of interesting. I haven't necessarily articulated this on the show prior, but it's kind of interesting to hear you talk about this, that really a good investment kind of area for climate tech only has to be something that has a lot of carbon emissions, right? Because if you can, in a really productive way, solve reducing the carbon emissions, you already know that you have product market fit. And obviously, this has kind of like been said between the lines within the show before. but I just think it's interesting to look into it. And do you have much perspective on investing into non like climate related markets in the past at all, where you could kind of compare maybe the mindsets of people there? I'm not sure if you mentioned anything
Yeah,
in your background.
I mean, I haven't done a ton of investing outside of climate tech and clean tech, but one thing I observe is I have a number of friends who are venture investors. Maybe they're like B2B SaaS generalists, right? That's their sweet spot is like, look, I love investing in software businesses that are B2B. And as I talk to those folks, and then I work with folks in the clean tech space, I think there's a lot of differences just in terms of cooperation, right? If you're a VC who focuses on B2B SaaS and that's your sweet spot, I tend to observe in a lot of the folks I know in that spot that they view each and every deal as like very competitive, which is to say, if I have access to this deal, I will be very tight-lipped about it. I won't share this with anybody. I will be really secretive about what I'm up to. Whereas what I see a lot more in the climate space is just a lot more of collaboration, where I will definitely take the time to follow up with a founder, rather than just ghosting them, which is a frequent complaint of founders about like, look, it wasn't a fit for this VC, fine, but I never heard why. I think that's important, and that's a frequent thing in the clean tech space that the investors do reach out back out to founders and say, hey, here's why it's not a fit for us. But they also are much more likely to say, but I know two or three other investors for whom I think you're a better fit than my fund. Let me think about, let me do the transition and the handoff so that I can make sure you find the right way to get funded. I think that's one of the biggest differences just in terms of mindset. And that probably has to do with both people being in the climate space for the right reasons, which is we need to generate these environmental outcomes. But also, a function of like clean tech is growing really quickly, and that's a good thing. And we want to really make sure that all the right ideas get funded, whether it's by any individual's fund or somebody else's fund. Like everybody in climate tech cares about making sure those businesses get funded.
Hmm. Hey there. Are you building a climate tech business and looking for very specialized talent? Consider reaching out to our sponsors, NextWave Partners. NextWave are experts in talent acquisition, recruitment, and retention across the climate tech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change yourself, feel free to reach out to NextWave at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page. Yeah, I definitely think it's interesting. I don't have any personal exposure necessarily in any real capacity to those other regular funds, but I have noticed a lot of collaboration in the climate tech space, and it's all about alignment, right? Everything, almost every person has mentioned that it matters who your investors
Yeah.
are, right? They have to be aligned with your interest or your kind of mission, because if there's a misalignment on the thesis or something, it's not going to work out nicely. So they'll just find somebody else who's better suited. um there's a lot of very interesting business models in climate tech. I think that's been one of my favorite things is seeing the new business models that are out there. Could you maybe talk about some of your favorite kind of clean tech business models that you've seen?
Yeah. Um, Maybe just taking a giant step back, what I've noticed about clean tech right now versus 10 years ago is how many business models are possible today that weren't possible 10, 12 years ago. So, clean tech 1.0, it was very much of a manufacturer model, right? People were building EV chargers and people were building solar assets, and that's where a lot of the venture dollars were going into, which now in retrospect, that clean tech 1.0 didn't work out particularly well. And but what has happened is we've learned a lot more about clean tech since then, and sort of what's the right financing solution for the right asset. So now we have lots of assets in the ground, right? EV chargers, solar, battery, like there's just huge amount of assets in the world from a clean tech perspective that didn't exist 10 years ago. Um, and that's fantastic because that allows people to build different models on top of those assets, marketplaces, right? Marketplaces in clean tech didn't exist 10 years ago. Now they do. A particular thing I'm seeing at sort of a thread right now is obviously there's still in clean tech, there tends to be a lot of higher upfront costs of assets, right? Whether that's a battery electric vehicle, something else. But much lower running costs, right? Everybody knows it's a lot cheaper to fuel an EV than it is to fuel a gasoline powered car. So what I'm seeing is a lot more businesses, subscription, hardware as a service. et cetera, that uses sort of fintech solutions and fintech approaches to make the initial customer costs of adopting that new technology a lot cheaper than having the customer worry about a giant capex. So you're seeing a lot of marketplaces, subscription, hardware as a service, et cetera, that are all focused on one of those levers of how do we make this, knowing that the long-term cost of ownership of this asset over 10 years, 15 years is cheaper, but the upfront cost is really significant. How do we use fintech solutions to help customers defray that cost? So that's like definitely happening in a lot of different parts of clean tech, is that hardware as a service model, which again didn't really exist 10 years ago, but now is diffused throughout the clean tech ecosystem.
Hmm. Yeah, I do think it's kind of interesting the idea of when you're spending on something like, I've tried to convince my parents to get an electric vehicle many times, right? Because they'd usually drive about 50 miles, to and from the town that they spend a lot of time in, right? 3, 4, 5 times a week sometimes, right? And I'm like, you guys are you constantly gassing this thing up, but you should get it, right? But it is difficult because of the upfront cost. But I do think that a lot of these purchases, yes, maybe the companies who come up with a hardware as a service type of model, but there's also a certain kind of, I guess, mindset shift. I think that I would like to see in consumers, which is being more thoughtful about what they purchase in the first place, right? Yes, it is more expensive, so you have to maybe save up for it, and you think more about these purchases, and then you can start to become a little bit more conscious of why are you buying it? Do you need it? Maybe there's a better option out there instead of just applying that kind of buy it now, I need it now mentality to
Yeah.
everything. Because you tend to do that with larger purchases. But if you don't have that mentality at all for larger purchases, especially, then it's going to kind of flow down to all the tiny purchases and all the wasteful, I really don't need these things, right? So I would be curious to see, like, en masse, does climate tech and its climate tech, technologies that come up for people to use actually change the psychology of purchasing in the consumer space? I don't know if you have any thoughts there.
Yeah, it's interesting. Obviously, yeah, there's I do see, and some of this is sort of outside of mobility and more focused on circular economy, et cetera, but I do notice a tendency amongst younger generations to be a lot more conscious about what they purchase and is it repairable. I think actually, sort of on that point, one of the things we're going to be faced with is, as it relates to that notion of circularity, is we're sort of up against an insurmountable amount of new capacity needed in terms of vehicle electrification and not enough factories in the world. And so even today, if every single medium and heavy duty truck factory in the world started producing only zero emissions vehicles, it probably wouldn't be enough. There's just not enough factory capacity
Mm-hmm.
globally to keep us Paris aligned. And so what I think we're going to end up with in a lot of cases is a circular economy approach where fleet managers take that same consumer approach of sustainability and say, okay, I have a dump truck, a street sweeper, or whatever. It is 5 years old. It has 20 years more of a lifespan or whatever it is in that vehicle class, rather than just scrap this vehicle and buy a new EV street sweeper. I'm going to actually think about retrofitting this street sweeper and making it electric. Partly because there's not enough vehicles available. There's the supply is smaller than demand. Partly because the economics are going to look pretty good on taking that approach of why should I scrap a perfectly good 5-year-old street sweeper, and why shouldn't I just think about ripping out the powertrain and replacing it with electric? So that's probably an example of where that same mentality
Mm-hmm.
um, is permeating mobility, right? Of saying like, let's just not like get rid of all these assets. Let's think about ways of taking the existing assets we have and making them sort of more future proof and durable to
Mm-hmm.
get out of that cycle of like, let's just buy something new. Let's just, keep purchasing our way through the problem.
Hey there. Are you building a climate tech business and looking for very specialized talent? Consider reaching out to our sponsors, NextWave Partners. NextWave are experts in talent acquisition, recruitment, and retention across the climate tech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change yourself, feel free to reach out to NextWave at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page.
To your point, sometimes it's a lot better to take a look at the existing assets you have and say, how can I just, use these rather than buying something new?
Mm-hmm. Yeah, and I think that there's a certain level of sophistication that obviously commercial use cases have because they're always looking at, hey, how much is this going to cost me over the lifetime value? And those are the customers where if you haven't figured out the financing model for hardware as a service, maybe you can, convince commercial use cases to purchase upfront because they are used to capital expenditure and then kind of amortizing it over the course of its lifetime. So maybe for people building that could be something worth noting. And on that note, since you've probably seen a pretty good amount of startups doing things in the space, what would your particular advice be to whether it's hardware as a service for a business model or something else you've seen where these people tend to make or founders tend to make a pretty common mistake? Is there anything that you would kind of offer as advice there?
You mean like in particular in the hardware space?
For any particular business model where you're like, oh man, it's another one of these. They're making this mistake this time. Like anything like that, because there's a
Yeah,
lot of these new business models and people just aren't familiar with.
yeah, sure. I mean, a couple of like pieces of founder advice. One is I think people, as you know, founders definitely get caught up in this is my features advantage versus the competitive set. Whether it's a grid or a table, it's always like, look, I've got the best features in, versus my peers. That's a sort of a short-sighted way of looking at it because usually you're comparing yourself to either, maybe a series B or C stage company and you're at pre-seed, or you're comparing yourself to a legacy company like a General Motors or an ABB or somebody who's got a massive, massive budget. And so it's a little naive to assume that like that your competitor who has a Series C stage funding or your competitor who's General Motors is not also innovating on features right now. Most likely they have a lot more in the features pipeline than you do as a startup. So one thing is always to think about just what's your right to win over the long term in that space, knowing that your Series C competitor and that, European multinational are going to be deploying all their resources on feature additions over time. What's going to be the thing that you do differently that allows you to get through that sort of onslaught from those competitors? Because again, features are they commoditize very quickly. And so you really need to think about like your enduring source of competitive advantage in a way um, that's not just, hey, I've got this widget on this device that other folks don't have, because that's very unlikely to be defensible. So that's a one piece of advice. And I think the other is on knowing the current legislation in your space. Like all all credit due to the federal government, the Inflation Reduction Act has unleashed like a very different, in a good way, um, sort of competitive playing field than existed, 2, 3 years ago. And it's really important for founders to understand the ins and outs of what the Inflation Reduction Act and CHIPS Act, et cetera, bipartisan infrastructure bill created as a competitive set to be able to justify and understand and explain, like, look, this is exactly how we're taking advantage of this, et cetera. And that also, applies to other regions of the world. The EU has the Green New Deal, et cetera, but really having an understanding of those new policy developments because they change markets. And then the final one, maybe linked to hardware and hardware as a service, et cetera, is really being smart on what's your full capital stack solution. And sort of my statement there is, in retrospect, if you're trying to launch maybe a scooter business, which has really good climate impacts, taking 300 million of venture capital dollars and buying commodity scooters was probably not the right capital decision, right? Like venture capital dollars should be funding your high risk bets, your innovation, your software development. But if you're buying, hardware off the shelf that's commodity, you better be really smart and disciplined up front about understanding, well, what sort of equipment financing solutions are available, what sort of debt providers can I tap into? Because it's definitely not a good use of capital to take venture capital dollars and just buy, millions of commodity hardware. So always a good idea for founders, even though it's painful because you're like, look, I'm just trying to raise a pre-seed round of venture capital or angel funding, whatever. I don't know yet the debt world. That's okay, but you need to pretty quickly identify like what are the available debt solutions and how could I tap into them and at what point can I start tapping into them, or grants, or whatever it is that says, look, there is some capital expense cost to building this business. I'm going to be very smart about being disciplined in terms of finding the right capital source for that business.
One thing I did not have prepared as a question, but I think I'd like to ask it and see what your thoughts are on this is you've mentioned a couple things in this last answer here that relate to the moat that people have, right? And you talked about if you're just built buying commodity hardware, how are you going to get acquired? Maybe you can make an impact on climate, but maybe it's an operations business. Could you talk a little bit about the kinds of moats that you find, from an investment perspective as to be the most attractive? Because despite us, trying to solve climate change, there still has to be some sort of moat, right? There has to be a real asset. That's why the investors from a venture perspective would come in. So could you talk about moats in this
Yeah,
space a little bit?
yeah. There's there's a lot of different ways, I think, to create a moat. And fundamentally, I think, what you're often answering is like, what is going to be the thing that's going to provide us with resiliency when we're attacked by, again, a later stage startup that might have raised a monster Series C or a legacy company. And so the way to think about that is like literally game it out as a founder and be like, okay, I succeed, and then it inspires 10 other competitors to come after me. Some of them are legacy, some of them are better funded startups. Like, what's the thing that makes me succeed? And that's a really, really useful exercise for founders. Some of the moats that you see are around IP and the defensibility of that IP or trade know-how. That some of that has an angle of legal protection, but a decent chunk of it is number of units deployed, et cetera, which has a learning curve associated with efficiencies, et cetera. So the sort of trade secrets IP is certainly one angle that people can think about from a moat. So even if you're buying commodity hardware, the way you deploy that hardware, how you marry that with software, et cetera, all of that can have some pretty interesting IP around it that can take a lot of time for somebody else to reverse engineer, decipher, because all the time you might be building on top of that moat with further software additions. So that's one. Certainly another potential moat is the sort of land grab. If you're the first in the marketplace, you definitely set a tone and a standard that other people have to try to dislodge you. That's one of the potential advantages of being first in a market is you could lock up competitors and say, hey, or customers and say, hey, in exchange for you coming with us, there's going to be a 2-year, 3-year exclusivity, et cetera. And linked to that, two-sided marketplaces tend to be pretty good in terms of moats because you've got both buyers and sellers, and for somebody to build that takes a whole lot of time. Another moat can be a brand that you are maniacal and focused on about building over time in a way that resonates with people, in a really meaningful way. In some ways, Tesla has built, many different moats, one around the charging infrastructure network, but certainly one around brand. Maybe the brand is a little bit, maybe a little bit weaker today than it was a year or two ago, but certainly there's a lot of legacy OEMs, car companies who built a brand over 100 years who said, gosh, I kind of would like to have the brand attributes and brand affinity that Tesla has. So that, in some ways also serves as a moat. So a couple different ways: two-sided marketplaces, customer lockup via, first land grab, brand and IP are often some of the ones that I see people work through to develop that competitive advantage that helps them survive the onslaught of competitors.
Mhm. And then one other thing I wanted to go back to was you mentioned was around people maybe having a solution that could be they could use debt financing to fix it, but they're not familiar with the space yet. So they raise venture capital. Are there any, pieces of advice on how people can figure that out? Any resources or I don't know, just general thoughts on that idea of maybe, hey, we don't understand debt, so we're just going to go with VC for now. But after we raise a seed or a very small, maybe a pre-seed, we'll then determine that. Like, what have you seen there?
Yeah,
I'd like to dig into that more.
sure. Well, one is I mentioned debt, but I would also underscore grants. One thing that some people forgot about relatively quickly with the Inflation Reduction Act is it's not just a series of tax breaks for certain clean technologies. It's also probably the most unprecedented offering of grants to help buy down technology costs and deployment across the clean tech sector. So startups should, that's publicly available information. The DOE, the DOT, et cetera, they try to do a very good job, albeit with, not the most up-to-date websites, but they still try to do a very good job of making everybody aware of this grant is coming. It's now available. Competitive applications look like this. So there's a number of like websites that folks can follow just to be kept in abreast of grant opportunities. One website that I use is opengrants.io. It's just a free website that allows you to track some of the major grants, both from the feds, but also at the state and even philanthropic. So don't rest on grants because, again, the federal government in the U.S. is giving away more in grants to buy down the cost of clean tech experiments than has ever happened in probably the history of the U.S. So that's one. And then on debt, I wrote a deep dive. I run a newsletter that publishes every 2 weeks around sort of sustainability and with a particular eye on mobility. And I did do a deep dive a couple weeks ago on the debt side of the equation. So, if people are interested and they're just listening casually on audio, like Alex Mitchell's Sustainability Debt, you can look at that, what I wrote there. But a couple of the principles and things to think through is, debt fundamentally for a startup, you're going to want to think through, is this a specific transaction that I'm trying to finance, or am I trying to finance part of the company itself? Transactions tend to be a little bit easier to get financing on as an earlier stage startup than the actual company itself. So what do I mean by a transaction? That could be like a customer contract, right? Like you're an early stage startup and yet you've gotten a 6-7 figure contract with the utility, with a large car company, whatever else. But they're not going to pay you back for another 6-7 months, but you've got to purchase those batteries, that EV infrastructure now. That would be an example where you should think about debt financing and how might I tap into somebody that can lend against that, customer purchase order, et cetera. The other thing that often becomes a solution and a tool for founders, again, not from the get-go, but is once you're in the revenue generating phase, is revenue-based financing, which allows you to basically get at the organization level, the company level, some financing that is basically predicated on your future revenue growth. And somebody will effectively take a cut of your future revenue and give you funding today to grow your business further. So a couple different options, customer financing, revenue-based financing, and certainly like equipment financing as you purchase equipment are all things that people should think about. What's the right use of capital for that? Because you definitely only want to use venture capital dollars to buy hardware, or at least decent amounts of hardware, when you have to, not because like you should look for other sources first.
And it's also nice to keep equity in your pocket, right?
Yeah, you keep a little bit of ownership of the company for yourself, for sure.
Yeah, exactly. All right, so I want to shift a little bit more to kind of your investment thesis. So kind of talking about how you manage deal flow and what you're working on there. So I'm kind of curious to understand from that perspective. Let's just start with deal flow in particular.
Yeah, deal flow. I'm always looking for hardware and software, or hardware combined with software. Again, anything in that space of pre-seed or seed stage that is around moving people and goods around the planet, while decreasing our greenhouse gas emissions. I actually am really fortunate. I run a newsletter that's about investing in this space, and I get actually a decent chunk of my deal flow from that newsletter. Startups reach out to me and say, "Hey, I just came out of stealth," or I'm about to come out of stealth. Could you include a nod to me in your next issue? I also have a lot of VC friends who subscribe to that newsletter and reach out to me saying, to the point of what we were talking about earlier, saying, "Hey, this wasn't quite a fit for me, but I think it's got real legs and they could benefit from being featured in the newsletter." The other thing is I tend to be very open on inbounds, right? That's one thing where some folks in the venture space are more, you've got to get to me via connection. I really am a believer in serendipity, heterogeneity of your network, really trying to be open to new sources of deal flow. So I'm totally open to folks, reaching out directly to me with a pitch. And in the spirit of what I said earlier, like I also try to do the digging in when I'm like, oh, this might not be a fit for me, refer that out to a couple friends who I think might be a better fit. The only thing I would say there, and then my caution I would give to founders is I'll reply to every tailored pitch. I don't definitely, I don't have the bandwidth to reply to the generic, like I'm pray and spraying with 200 VCs, and just hoping one or two or three of them reach back. For example, I don't currently invest in sustainable water technology or plastics recycling. I love both those businesses and I love the people doing it, but that's not what I'm currently investing in. And so if somebody reaches out to me with a generic pitch, it's a sign that they probably haven't done the research, haven't looked at the website, and haven't saw what I do. And those I'm not likely to reply to. But anybody who comes to me with like sort of a tailored couple sentences is like, here's why I'm reaching out to you. I'll take the time to look at the deck, often take the time to get on a call with them and assess out whether it's a good idea for me or somebody else to continue with.
Hmm. Yeah, so I don't necessarily work in this space, but because of some of the things I'm involved in like Forward VC as a mentor, I get all these people reaching out, and I can't imagine if they're reaching out to me, that means they're hitting a lot of people with such a non-tailored thing. It's like you definitely did not spend even 2 seconds, looking at my profile.
Yeah.
Uh,
Yeah.
so that's interesting. But I guess with that said, maybe you could talk a little bit about what specifically are the things that really help you understand a pitch, right? What are the components that need to be included in a deck for you to truly, okay, this is in the mobility space, even though people are reaching out with other things when it's clearly stated on your website, but this is in my space, but beyond that, how do I determine whether or not this is for me? What are those key components?
Yeah. Um, Given that I invest at the pre-seed and seed stage, one of the really, really important things is you're fundamentally investing in people at this stage. By series C and D, you can be at a situation in a time where actually the founding team might have stepped down and they've brought in, somebody who's got experience with IPO markets, et cetera. That's not what you're looking at pre-seed and seed. You're fundamentally making a bet on the individuals themselves. So I'm definitely going deep on who is this person, what motivates them, what in their lived experience has brought them to this point, how do they show grit and determination, because that goes a lot further than prestige. Just because somebody went to X university or worked at Y consultancy or investment bank, that's infinitely less valuable than somebody who's just got that hustle and grit and drive and determination. So that's definitely something super important. And I think actually a lot of people leave themselves out of the pitch or try to minimize themselves out of fear of, self-promoting or not getting the investor's attention about the pitch, or the business model. But like fundamentally the pre-seed and seed, it's really about the individual, because you as the investor know that business will likely have a pivot or two. And so it may go away from that original concept over time. And that's why it's so important for the founder and the investor to see eye to eye about who the founder is, what he or she brings to the table, et cetera. So the grit and determination and sort of story of the founder is super important, and don't forget that. Another thing is the size of opportunity. I don't necessarily find a lot of the analysis behind TAM and SOM and et cetera to be super compelling, but it still is fundamental to understand, are we talking about something that's big and can generate venture scale returns? Or are we talking about something that's a smaller business? Proving that this is a really big idea is vital for the sort of alignment with venture economics. And then third thing, which I think a lot of founders miss and is really important, is timing. It can actually be really dangerous, just as dangerous to be too late to a market as it can be to be too early. Looking back, for example, on a really company that raised a ton of money during CleanTech 1.0 was called Better Place, which was a battery swap network for vehicles. That is a business that raised a ton of money and went bankrupt. But that's a business that's now just beginning to reemerge as the sort of favorability of the marketplace sort of allows it to, battery swap as a technology. And so I think a lot of founders don't think enough and really articulate enough about why now? Like, is there a risk that I'm being too early in this market and there's not enough customers yet, there's not enough demand? Or is there a risk that I'm going to make it too late? But there is actually a penalty to being too early. And so you really, really want to think through, like, why is now the best time to launch this business and not in 2 years from now, not in 1 year from now? Because that has a huge impact. There's definitely some pain associated with being too early in the market.
Yeah, talking about this too early, too late thing reminds me of, I think it would be probably almost 2 years ago when I remember a lot of people talking about the idea of tracking carbon emissions, right? And then you
Yeah.
have a couple ESG data tracking platforms that were already there, and you didn't really know about them that well because it just, it wasn't necessarily a hot topic. And then fast forward maybe 7, 8 months, and it's suddenly there's 100,000 of these, right? In LinkedIn inbox every single day, trying to hit you up. Hey, we've got this ESG data platform. And this is a question I had prepared, which is around kind of bandwagoning, right? Where people, because they're like, okay, climate is an issue we need to solve. Let's get to it. And they see this idea that's like, oh, this is very clearly a great idea. We need to solve this. And especially because it's software, a whole bunch of people rush in, right? It doesn't require brand new technology or something like that, right? It's just a software product. And then you've got all these people rushing in, and then maybe you pair that with investors who are newer to the space. In particular, I think that moment in time was a bad one because you had a lot of people from VC traditionally just moving into like, oh, here's a software play in, in climate, so let's get on it. Do you have any comments on this idea of like how do we prevent this kind of thing from happening where people just pile into one thing just because, hey, this seems like this really good firm over there is doing it, so let's do it too. What are your thoughts on that in general, and how it can be harmful?
Yeah. Um, I mean, part of that is just the nature of innovation. Somebody, strikes up an idea, a concept, and it invites imitation, which is the sincerest form of flattery. And there's a lot of cases where the first mover doesn't win a market. It's somebody who's later in the market who ends up winning. So I don't necessarily have a challenge with bandwagoning in general, because again, a lot of companies who are first movers make mistakes, they fail, they don't adequately learn, and fast followers can sometimes succeed. An example of that touches the transportation space was Uber was not the first person to do peer-to-peer ride hail. That was a company called Sidecar, and Uber happened to out execute Sidecar on peer-to-peer ride hailing. I like you have seen the growth of carbon accounting, the explosive growth of that space. And similarly, there's a lot of folks now focused on medium and heavy duty fleet decarbonization. We sort of acknowledge that, like, hey, the passenger car thing is tipping fairly quickly towards electrification, but it's a thornier problem for medium and heavy duty fleets. What I would say both of those have in common that I've observed as it relates to bandwagoning is that the thing I just talked about earlier, which is like, how does it link to the founder's story and who the founder is? Because that's where often, sustainability of the business can happen when you have a founder who's deeply passionate, steeped in the area, already knows the topic, rather than somebody who says, hey, it appears like a lot of people are doing fleet decarbonization. Let me jump into the space. That's very different from somebody who says, I grew up in a household where we had a fleet management business. I was actually a truck driver during my university years to help pay the bills, or even somebody who says, "Hey, I acknowledge that a lot of people are in this space. To really deepen my customer discovery, I spent the last 4 months either riding along in other people's trucks or being my own independent truck driver to help get a sense of understanding." So I think a lot of the what I look for as like a market sort of starts to bandwagon is, where is there better sort of founder fit with that business model? Who has actual, personal lived experience related to that? Who has done the customer discovery of saying, Oh yeah, I haven't just launched like a fleet decarbonization business, but I spent the last, 4 months talking to 100 fleets, and I really itemized what I was looking for.
Hmm.
So that's one thing, on bandwagoning is looking for founders who have a legitimate personal, sort of let's call it skin in the game on the topic. That's certainly one thing. Another thing is I always try to take a look at sort of who's behind the bandwagoning. And an example of that is in hydrogen, where maybe some of the I'm definitely not a rose-colored glasses optimist on the role of hydrogen in all forms of surface transportation. Hydrogen has really a lot of limits in my mind, but a lot of what is prompting some of the momentum or bandwagoning around hydrogen is sort of oil and gas companies looking for a way to minimize maybe sort of the transformation on their business to adapt to the decarbonized era, and saying, well, like let's just push hydrogen. It's fairly aligned with our current business processes and structures. So also good when a market starts to bandwagon, really understanding who's sort of excited about that and why, because that sort of tells you a lot about whether this is a demand driven bandwagon, a supply driven bandwagon, and in the case of hydrogen, sometimes it's much more of a supply driven bandwagon
Hmm.
market.
Yeah, it's quite interesting actually. That's I've always wondered how people determine, if they're really being thoughtful, what investments to make there, especially when there's a lot of them popping up. I think it's fine. I think it's kind of funny when you see that this is kind of unrelated, but you see with the big AI bubble right now that literally everybody has to put AI in their pitch in some way, right? Like if they don't, they're probably being silly, right? But also I find it funny that a lot of people I've seen who are big in AI right now, you look at like some of their past work and they were just recently in the Web3 bubble too, right? And I'm just wondering,
Yeah.
like, is it the nature of some people to just chase that big trend, right?
Yeah, I think that is, and that's sort of that gets again to like the benefit of as a founder, the importance of finding investors who are aligned with you. I've been with clean tech since 2010, and there's definitely been some times over the last 5 to 10 years where clean tech was a four-letter word, and investors were like, "Ugh, like what a terrible segment." And there's a whole host of folks who said, I choose to go forward with clean tech rather than adopting the latest trend.
Hmm.
But there's also founders for whom, being associated with an investor who's maybe frequently changed their focus area is exciting because they say, hey, this investor is going to help me keep an eye on what's the next big thing. Um, I'm unabashedly focused and sort of, narrow in what I get excited about from investing. And that's, again, that decarbonization of mobility. And I'll be with that through the ups and downs. And that's sort of my angle as an investor. But there's other investors who say, hey, part of my generating good returns is really seeing the AI opportunity before other people do, and I saw crypto before other people did in Web3, et cetera, and I just surfed that wave over and over again. And that's probably a good fit for certain founders and certain investors. But it speaks to the importance of when you're a founder, of really doing some research on like, who am I taking a check from? Yes, I need a check, but don't just take any check. Take a check with somebody where you're like, hey, sort of what their values, their insights, their focus, whatever, is that aligned with what I need and want from an investor, or am I just, conveniently taking a check right now?
Hmm. Yeah, that's interesting. I think I also think that there's something kind of in the tech space broadly that there's kind of this, I know you call it like I don't know how I would refer to it. Like I would want to say like bottom dwellers or something. The people in the in the tech spaces who are just like, this is an industry, right? You come up with an idea, you go raise money, you live a certain lifestyle, you get to party, and then you just, yeah, it doesn't work out, but that's okay because in Silicon Valley, failing is not a big deal, right? And then they just keep doing it. I've seen people like this where it's like, okay, they're just doing it again, but it's okay. I do want to
Yeah.
get on to something that I think is quite interesting, which you can speak to probably much better than almost any guest I've had on so far, which is this idea of incubators. So could you talk a little bit about the incubator and the process there and what you see as the value with an incubator?
Yeah. Um, well, let me talk about, LACI, and what I had as capacity in terms of what I was doing at LACI, and then a little bit more broadly around incubators in general. So like I said, LACI is an 11-year-old nonprofit clean tech incubator, mission of creating an inclusive green economy. I'm now an advisor, but previously I was in the line management role of running all the founder-facing work, so supporting about 50 clean tech startups at once across zero emissions mobility, clean energy, and circular economy. The core incubation program of LACI is a 2-year program that starts off with about 3.5 months of curriculum. Where LACI is unique as an incubator is really focused on what I sometimes refer to as the 3 Ps: pilots, policy, and partnerships. So LACI, for its incubation program, gives startups about $20,000 to $50,000 to defray the cost of their first customer deployment. A lot more important than that, though, LACI really has developed a real body of work around that first customer deployment, that pilot experience, that is taught in the curriculum of how to structure a pilot, how to think about risk, what metrics to track that help you avoid the valley of death, all that sort of stuff. Policy, LACI really leads into making sure startups understanding, I mentioned the Inflation Reduction Act, et cetera, exposing startups to that and helping them understand that. And then partners, LACI just has a strong stable of corporate and government partners. An example of that is Los Angeles Department of Water and Power is one of the founding partners of LACI, the largest municipally owned utility in the U.S., and is always working with LACI startups on piloting a technology, piloting a concept. So that's a little bit about LACI. What I think of incubators and venture capital as existing along a spectrum of sort of services for startups. And at maybe one end of the spectrum, you have venture capital, which is cash and some services, advice, connections, mentorship, board governance at times. And then incubators, maybe sometimes being a little bit on the other end of the spectrum, which is probably less money and more services. So in the case of LACI, for example, the founders, they get 1 hour per week of executive coaching. They also get a budget to do to tap into like a credit system of paid services with legal, accounting, marketing, whatever else. So I think of incubation and venture capital as sort of like a spectrum of a trade-off between dollars and services. What I think is important in both cases is for founders to really think through, like, what do I want out of that experience? And I've observed over time that the startups who are the most vague, like, oh, I just want help, or I kind of want the logo of this or this incubator, that's significantly less valuable than coming to the door and saying like, hey, I'm at just beginning commercialization stages. I want to use the next year to really trial with both whatever hardware as a service and the manufacturing sales model, and see a fee for service, whatever it is, and see which has superior economics, that as I go out for my seed raise, I've got really good traction. So that's probably the biggest thing that founders need to think about, is like, be really crisp and clear with yourself and when you apply about what are the 2 or 3 things I want to accomplish as KPIs, outcomes, with this incubator or accelerator, so that you're holding yourself accountable, but you're also holding them accountable to that as you go through the program.
Mm-hmm. So who are the people who go into the program? I'm kind of curious, like, how do you, what stage are they usually at? And then how do they determine whether or not to accept them?
Yeah. So when a founder is applying to LACI, they've used for the LACI's incubation program. LACI has multiple different programs, but the best known is the core incubation program. They've usually got a functioning and ready for commercialization prototype. They are ready to take on revenue, therefore. They have 2 full-time founders, or at least an understanding of, if there's only one, why there's 1 and not 2, but they need to be ready to go full-time. And obviously it's got to have some of those climate impacts that LACI cares about, and in those sectors of zero emissions mobility, clean energy, and circular economy for LACI. And then, what LACI's looking for as an incubator when a company applies is similar to what I mentioned personally, is like that founder grit and tenacity, right? Does the founder have the ability to like really face a challenging moment and come through it? For an incubator, all incubators, but including LACI, look for, is this founder coachable? Because fundamentally, I mentioned that spectrum of services versus dollars. The services only work if somebody's willing to listen, take the feedback, and be told, like, yeah, this pitch deck, like, it really needs to be redone to be able to be put in front of investors. So coachability is really key. LACI is a nonprofit, so they also care. One of the things LACI cares about is the job generation potential. Can this company become a meaningful economic development opportunity, particularly in the LA region? But also looking for things that the later venture capital community might care about. How big is this idea, and as it scales, how much climate impact is there going to be? Uh, those are key factors that go into, like, is this a good fit to bring this founder? And then the third thing is, in the interview process, LACI will ask, what are you hoping to get out of this program? And when founders haven't put a lot of thought into it, and they're just like, oh, I'd like the LACI name, or I want to be part of the network, that's very different than saying, look, as I look through the next 2 years, here's what I think looks like for for success for me, and here's what I hope the incubation services can help me achieve.
Mhm. On a more broad note um with incubators, I'm kind of curious your thoughts on how they're most valuable, because it sounds as though this one is largely focused on, hey, what are problems we can solve locally in LA? But because of that, they also likely have, as you mentioned, some of the founding partners of that, they have network that is very valuable in that space. Obviously, most of these companies are going to likely go on to build and expand beyond that market. But I'm just kind of curious because usually these things are very difficult. Building a company and building like a network where you're going to get value, it comes down to having a very high quality number of small-ish number of contacts, right? It's not like you get thrown into a pool of 10,000 people and here's the value, right? So can you talk about your kind of philosophy on incubators if you have one? How are they best positioned if somebody wants to build one, and where might it be valuable versus, hey, this is probably not a great application of that time and effort.
You're talking about if somebody wants to build an incubator themselves,
Yeah,
like what do they need to think about?
either building an incubator or people considering joining one, like which ones to join. Because I want to
Yeah,
understand from your perspective where can an incubator be very, very valuable versus, hey, this is probably a bad idea or a waste of time.
yeah. Um, Again, like, that definitely comes down to what the founder articulates they're really looking to get out of the program. But for example, LACI, in part thanks to its leadership, in part thanks to 11 years on the ground, LACI has that local network of the major utilities, the public transportation authorities, city governments, but also corporates like BMW at the table. And so if you say, hey, look, LACI does pilots, and they actually happen to have all the major um, corporate and government partners who are leaders locally in deploying clean technologies, that makes LACI a very good fit for somebody who says, look, piloting my technology in situ in the second biggest city in the US um, is of real importance. One of the things that I think founders definitely do want to think about as they think about which incubator is right for me is duration and your peer cohort, and how much of that is in person versus remote. There are some founders for whom, look, I am committed to staying in Missoula, Montana. That's where my startup is. I'm not really wanting to move. That would lead you much more to a digital first experience, or a incubator accelerator where you say, look, I might move to LA, Miami, Chicago, whatever, for 3 months and then be right back home. There are other founders for whom that in-person experience over the long haul is vital, and they say, like, I want a peer cohort of folks who I've spent 6 months on the ground with, so that when I call them up 2 years later and say, hey, I'm having trouble with my CFO, I think I might need to fire him or her, they have a really deep peer network. I think fundamentally what some folks don't realize when they look at an incubator is you get a lot of value during and after the program with the incubator itself, but you would be very well served to build those relationships with your peers in the incubation program, other founders, because that becomes, your sort of wolf pack, your hunting pack over the course of your career. Like, the most impressive LACI startups are the ones who say, hey, I'm really busy. I'm trying to do my seed raise, but I'm going to spend 45 minutes with this other founder, like, cranking on this problem she's got, and just it'll probably pay back at some point. And it does. Those who give get something, those who give without expectation sort of get something later on. And those are the kind of founders who then like come, back to you 6 months later and be like, hey, guess what? I just submitted a joint RFP response with this other founder, and now we just snagged a contract that neither of us could have gotten on our own. So that like peer network within the incubator is super important to think through.
Yeah, that is pretty fascinating. That idea of um building networks and building relationships with people you're already in proximity to is something I've noticed. I think a lot of people are very bad at. There's a lot of times where you have great, I don't know if you want to, it sounds very commercial, but you have great assets, right? These people around you who, yeah, maybe they are not necessarily in a position to help you at this exact moment. However, you don't know what they might be able to help you accomplish later on or
Yeah.
the insight they can have for you. And I think for me, one of the biggest things was from moving from Wisconsin to New York, is I realized that if you're going to get a meeting with somebody in New York, you have to have a very particular reason. And I found that to be a little bit annoying. I was like, well, how do you know? Like, what if I can help you? Right. In Wisconsin, they're like, yeah, let's get a coffee for an hour and have no agenda. Right. But in New York, it's a different world. But we are out of time here. Any kind of final calls to action or things you want to wrap up with? Any final thoughts?
Um, no, I mean, I'm grateful to you for hosting this podcast. I celebrate, as somebody who had my climate awakening, you know, 14 or so years ago, each week, each month, there's more folks who want to come into the climate space, and that's exactly what we want, what we need. That more, would-be founders are saying, hey, rather than tackling creating something that doesn't have environmental impact, I'm going to focus on creating something that does. And I love that folks are doing that. So thank you for creating a platform for, people who are new to the climate space to learn more about it so that they can figure out how do I best, sort of contribute both to like my professional development, but also to making sure we have climate outcomes.
Yeah, absolutely. I really appreciate that. I think for me, it's fascinating being from a place where there's not a lot of people who are interested in climate, at least not where I'm from in particular county, and seeing that the fact a lot of the people who have come on the show have come from conventional industries who knew the space very well and therefore were able to actually make a much greater climate impact than somebody who's just like, hey, let's solve a problem and trying to find kind of a, like a nail, a hammer with looking for a nail. So I do hope I don't know how you distribute, content to an audience that's not necessarily looking for it. But hopefully it falls upon some ears. So it's been a pleasure having you on. I'd be very keen to continue following on your journey and then have you on again in the
Yeah,
future. I think there's
wonderful.
more conversation to be had here. So thanks so much
Yeah.
for coming on, Alex.
Thank you, Silas.